Hello everyone. This chapter we are focusing on adjusting entries, but before we jump into the nuts and bolts of journal entries and debits and credits, I want to take a moment to talk about why we are doing this. The reason for adjusting entries all comes down to a crucial principle in accounting, making sure our financial statements are accurate. In your personal life, you probably use a cash basis of accounting, and this is simple. You record income when cash comes into your bank account, and you record expenses when cash leaves your bank account. But for businesses, especially larger ones, that doesn't always give a clear picture of what is happening. This is where accrual accounting comes in. Accrual accounting is a core principle of GAAP, which is generally accepted accounting principles, the standards we discussed in an earlier video to make sure everyone is speaking the same language. Under accrual accounting, we record a transaction not when the cash changes hands, but when the event or the transaction actually happens. One of the principles associated with this is called the revenue recognition principle. And that tells us we should record revenue in the period, meaning the month or the year in which it is actually earned, not necessarily when the cash was received. Those could be in two different periods. For example, imagine you're a painter and the client pays you $1,000 in July for a mural you'll paint in August. Under the cash basis of accounting, you'd record $1,000 of revenue in July because that's when you got the cash. Under the accrual basis, you wouldn't record that revenue until August when you actually did the work. We do this because we want our financial statements to reflect what happened in a given period. The company didn't earn that revenue in July, it just got the cash. The revenue was earned in August when the painting was completed. This works the same way for expenses. The expense recognition principle is also called the matching principle. It says that we need to record expenses in the same period as the revenue they helped generate. That's the matching part of it. So we match the expenses to the revenues that they helped create. Let's stick with the painter example. Let's say you bought $50 of paint in July for the mural you'll paint in August. Under the cash basis, you would record that $50 expense in July. However, under the accrual basis, you would not. You would wait until August and match that $50 expense with $1,000 in revenue, because that paint helped you create the painting and do the work that you did in August. You can also look at it as I didn't use the paint until August, and therefore we have to ask ourselves the question, when did we use things, not necessarily when did we pay for them. And we need to make these adjustments because the expense was incurred to create the August revenue. So if we only used cash accounting, a company's financial statements could be very misleading. A company could get a huge cash payment in December for work it will do next year, making it look incredibly profitable at the end of the year. Or we could be doing a ton of work this year but not get paid for it next year, and we wouldn't receive credit for actually doing that work this year because we didn't get the cash. So adjusting entries are the tools that we use to make sure that revenues and expenses are matched up in the correct period. We do this to ensure our financial statements are accurate and give a true picture of the company's financial health. In our next video, we'll dive into a simple 3-step framework that will help you tackle any adjusting entry. And I'll see you there.